Pulkit Agarwal, the head of India content, S&P Global Energy Insights, to get a better sense of what this action could lead out into, or how this development could play out for the global market at large. Pulkit, hi, morning, and thanks for your time. First up, help us understand the kind of impact that you're expecting to see from this geopolitical development, both in terms of the kind of oil unlocking that happens for the world and the impact that it could have on the US markets too.
So, in terms of the global crude oil markets, this does not immediately mean more oil for the markets because what has happened in Venezuela over the past few years is, there has been persistent underinvestments in terms of assets, and which means that, while sanctions may be lifted, but the problem of Venezuela in terms of lower production is not just about sanctions. It's also about the technology available, the facilities, the infrastructure available in that country to produce more oil. So this doesn't translate to more oil immediately. For in a 6 to 8 months time frame, it's not expected, that market is not expecting that more oil will come out from Venezuela. Of course, if we look at a longer time frame, 3 to 5 years, with billions of dollars of investments, if it happens, there is definitely more resource available there, to be supplied to the world. In terms of sort of for the U.S. markets, U.S. was getting some of the Venezuelan crude oil through an exemption that was available to one of the oil companies. Uh, uh, some more can flow definitely, but the primary destination for Venezuelan barrels remains China, and it is expected to remain China for now.
Okay, so Pulkit, appreciate that take coming in, but also talk to us about the timeline. Like you were saying that this is not something that can play out in the next 6 to 8 months. How much time do you think that this is going to take to play out now that Donald Trump is encouraging US energy companies to start investing and start building up the oil infra in Venezuela once again? How do you think this could play out?
So, see, the way how Venezuelan oil comes out to the market is slightly more complicated as compared to resource available in other places. It's a very heavy sour crude oil which needs blending down. So it's a bit of a complicated process. These are facilities which have not been maintained for decades. There are sort of lack of people, human resources available to process this crude oil. So very frankly, for the next 3 to 5 years, not a whole lot can be and should be expected, in terms of the amount of barrel that is coming out of Venezuela. Of course, there can be slight uptick here and there, but nothing of note. Venezuela is, think about it. Venezuela right now is about a percent of global, not even a percent of global crude oil supplies. Uh, but at the same time, it does supply about 7 to 8% of global heavy crude oil supplies. So, anything coming out from US, a finer point is not about sort of the overall volume of crude oil coming out to the market, but the heavy quality of crude oil coming out of the market, because not a lot is there, and Venezuela is quite rich in heavy crude oil.
Right, Pulkit. Hi, this is Harsh here. Pulkit, if I were to try and understand the energy complex better from an Indian context or perspective, there's so much happening on the geopolitical side. How much of a benefit has India had of Russian crude over the last couple of years, and how significant is the fact that we will be moving away from Russian crude? Give us a sense of that.
So, I would sort of go back to hard numbers. Where S&P Global Platts have assessed the price of Russian Urals over the last few years. Those discounts, when we started looking at this market in the start of 2023, the discounts were as good as about $16 to $17 to dated Brent landed into the west coast of India. Then it subsequently narrowed quite significantly to sort of $3 $2.5 levels, and it remained there, for the large part of 2024 and 2025. What has happened over the last 2 months is, those discounts have widened again, because the risk perception of buying Russian crude again has gone up in the last 2 months, because of all the sanctioned actions, that has been taken by US and Europe. So, there has been, quite a significant discount that any buyer of Russian crude, including India, would have enjoyed over the past couple of years. In terms of, the fate of flow of Russian crude into India, that's anybody's guess in terms of, how that would turn up. These are complex geopolitical issues. While we have seen, some fluctuations in flows in the last 2 months, we have not really seen, flows sort of vanish, right? So, we do see flows of Russian crude, coming out into India as well. Yeah.
And how much of that benefit, Pulkit, comes to Indian OMCs as well as Indian refiners, if I can ask you that? Because you're clearly seeing pressure and on stock prices today, and I'm not asking you to comment on that pressure, but I'm trying to understand whether it's justified and how large or how material is that impact.
So, of course, I'll stay away from sort of commenting on, what matters to the stock prices. But, in terms of the price levels of Russian crude landing up in India right now, where we are assessing that is $7 discount to dated, or thereabouts, landed on the west coast of India, which means any Indian buyer, which is any of the refiner that is consuming, would essentially, right now, if anyone is buying a barrel of Russian Urals into the west coast of India, and east coast of India would not be mightily different from that, but it would be about $7 discount to dated Brent. So it's a sizable benefit right now. The benefit or the discounts have gone up, as I said, over the last 2 months, because the risk perception with Russian crude has gone up quite significantly as well. So,
Okay, and Pulkit, just trying to understand what the global oil pricing dynamic could be, given that you have OPEC Plus on one hand, that in its meeting over the weekend, they've called for a pause yet again. On the other side, as and when this plays out, we understand it could take time. But when it does, what do you think the supply of oil could look like in the market, and eventually, what could the pricing be?
So, and I'll take reference to our S&P Global Energy, analytics team, who sees the current market being oversupplied by the tune of more than 1 million barrels per day, and this sort of situation of oversupply has been continuing for some time, which means that we've seen a lot of stock build happening around the world, onshore and offshore, over the past few months. It is expected widely in the market that this situation of oversupply will remain, at least until the summers of 2026, when it will start easing. So, in terms of the oil markets, the sort of the demand is quite seasonal as well. So there is a wide variation between winter demand and summer demand. Right now, we are in a lean demand period. So, overall, the picture looks quite weak in terms of the oil markets. And that is why all of these geopolitical factors have not done much to the price. In terms of the pure sort of pricing dynamics, our analysts, back in the office, uh, do see oil prices remaining sub $60 level, and this is at dated Brent, I'm talking about. They see prices of sub $60 levels in the first half of 2026.
Okay, Pulkit, appreciate that outlook, and thank you once again for taking the time out and speaking with us. Great chatting with you today.
Thank you so much.